And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined by Tim Seymour of Seymour Asset Management and Kevin O'Leary of O'Shares. Let's get started with the big story of the day, and that's China soaring after President Trump tweeted he would delay the deadline to increase tariffs. The FXI, that's a large-cap China ETF, now outperforming the S&P 500 this year, up more than 15%. Should you get in on this China rally, and what's the best way to play it? That's what we do here. Tim, you're the emerging markets expert. Are we off the lows? As we noted here, we're getting an outperformance from China. We haven't seen that in a while.
Yeah, well off the lows, Bob. And one of the things I know from my history in emerging markets, EM always tends to bottom first. So actually, this outperformance by the FXI is not just year to date, it's not just last week. It's actually since October you've actually seen the FXI outperforming the S&P, and I think there's reasons for that. Some of this is that this trade war caught China flat-footed, believe it or not. They were in a tightening mode. You had a dynamic here where I actually think that this was the worst possible time for this to come down on China. Good news for our politicians, I guess, tactically. But bottom line here is without tariffs, and China's actually now stimulating. There's been triple R cuts. They've actually begun to cut taxes. They've begun to pump money into the system, which we all know is a concern in the longer term. But in the short term, I actually think that Chinese stocks are not only cheap, but technically, you know, you have the Shanghai through the 200-day for the first time in over a year. You've got a lot of important technical factors that are wind at the back.
We went from, do you buy this narrative? We went from a China slowdown 6 months ago. The Chinese are desperately trying to stimulate. There's way too much leverage. There's way too much debt in the economy. The retail investor in China got burned badly a couple years ago. They didn't come back. Suddenly the narrative has changed around.
Well, they got beaten up pretty badly. You were down 48 to 58% on the typical Chinese name. So when wave past what anything did here, now it's coming and, you know, filling in the gap. The one thing I would say about this that's going to catch a lot of people off guard, if you didn't have an allocation through this whole volatility to emerging markets, specifically Asia, you're now going to underperform the global index by a material amount, probably 200 to 300 basis points if you're a money manager. Having no exposure to emerging markets is always a mistake over a 5-year period. That's what I found.
Okay.
So you have to take the pain on volatility.
We do want to point out this show is about how the ETF business works, and not all ETFs are created equal, particularly the Chinese ETFs that are out there. We can point out a couple of things here. The FXI is the large cap one is 50 Chinese stocks, but they're all Hong Kong listed stocks.
Yep.
So those are big industrial names and bank names.
State-owned enterprises.
That's right.
Et cetera.
SOEs, as we like to call them. The China ETF, the MSCI, the MCHI is the symbol there, has a broader mix. Hong Kong, mainland China stocks, and U.S. stocks like Alibaba. A lot of people don't understand. You own FXI, you don't own Alibaba, which trades right here. Behind me.
But they are sort of correlated. The point is, if you want to own China, own them both, because frankly, they're not that different. And if you want to get every name, these are the two that captures them. But there's so many state-owned enterprises in there. That's funky chicken stuff. That's the problem.
And of course, companies that have significant exposure to China have generally rallied along with the Chinese market, if you look at it, particularly some of the chip names. So for example, Skyworks, Qorvo, Qualcomm, NVIDIA, all get more than 50% of their revenues in China, and I just picked the December 24th low there. You can see generally they're all outperforming. Qualcomm is the one exception there. So U.S. stocks are clearly responding to what's going on in China.
Yeah, look at the SMH. I mean, you know, we could make an argument again if we wanted to follow a path for really what was going on with the China negotiations. You've been following the SMH, which is again the ETF that tracks the semis, and the semis, which are cyclically most exposed to China. That was the trade that first broke down back in July, and arguably, in fact, semis are up about 26% off that Christmas Eve bottom, significantly outperforming the S&P. And so, you know, that to me is a tale where I don't think we've solved all the problems overnight with some relatively vague edict that came out. But I do think that the market overpriced all of these companies grinding to a halt.
There'll be more China shares on the market. MSCI likely is going to increase the China weighting a little bit later than this year. That's
and there's demand. And there's demand for that. If this truly is going to end up with a fair trade deal, including protection of intellectual property, this is going to benefit both sides of the equation. And they still have better GDP growth than we do. Whether you believe the government numbers or not, they're either 5 to 6.5%. They're in there somewhere, which is basically twice what we've got.
So, Tim, how do we play a trade deal? What do we do here?
Well, first of all, I think some of the industrial names that are exposed to China, but I like FXI because I think a lot of the Chinese banks are particularly cheap, and a lot of them look to be most vulnerable on the credit side in terms of a world where you're starving them from liquidity. You talked about Alibaba. First of all, one of the first stocks to break out and technically to actually overcome some of the resistance levels of last year was Alibaba. Remember, the Chinese mega cap tech names were some of the most popular trades in 2017. They were some of the worst trades in 2018. Yeah. I think you've actually reconciled a lot of the positioning there, and I think you've really outperformed. But valuation, to me, if you believe that China is getting at least not only this sentiment boost here, but that actually the government is reflating their economy a bit. Yeah. Look, Alibaba's not a trade stock, but it was treated like one.
But
I love that.
But is it? You just need to know when to play the turn, though. I mean, is it true
it's
that he
hard.
says that they all turn around here at this
It's
point?
so hard to catch the knife with China. The volatility is twice what our market is, basically. And what I've learned is, as an investor, you just got to suck it up and take the pain. If you want to have 5, 10, 15% in the Asian markets, which you should, you've just got to get ready for volatility in your portfolio. And it hurts.
And this isn't a knife. I mean, again, everything you just said, Kevin, I love that. The point is, you've got the opposite going on. You need to kind of ride this momentum. That's how you want to play it.